2025. Investors, is it time to buy, time to hold, time to sell? Investors want to know what moves to make in the coming year. You're the expert, Rick. Where are we going?
I think there's always opportunities for investors. The old saying is a savvy investor can do well in a strong market or a weak market, and I think we'll need some savvy investors to navigate this year's twists and turns. Um, Home prices are going up, but marginally. They're going up more in certain parts of the country than other parts. I think we're seeing a movement toward having workers return to office. That will probably slow down some of the interstate migration that we've seen over the last few years. So I think investors are going to have to keep that in mind if they're investing in properties out of state. But from what I see and from what we've seen in the last couple surveys that we've done, the RCN Capital Investor Sentiment surveys, it does look like there's probably more opportunities in the short term for investors to buy properties, fix them up, and hold them as rentals than we're likely to see in the fix and flip market, at least as we go through 2025.
So when we think about the potential of fix and flip coming back into the mix, because it's been a rough couple of years for the fix and flip crowd, just from the tremendous lack of inventory, not only in the MLS market, but even off market. It's been a rough go of it. How do we see that turning around, even marginally, Rick?
That's the billion-dollar question, Jeff. I have a hard time getting too enthusiastic about the outlook for fixing and flipping this year. One of the things fix and flippers need is a market where prices are going up at a fairly healthy clip because they can buy a property for a little bit below market value and still turn a profit at the end after they fix the place up. We're not seeing home prices go up much in most parts of the country. And the other X factor here is that it's very likely that both labor costs and repair costs are going to increase this year, which puts pressure on margins for a flipper. If the tariffs are that the Trump administration has been talking about are levied as been discussed, it's going to make lumber prices go up. It's going to make drywall prices go up. It's going to make flooring materials go up. Probably some other materials and fixtures that I'm not talking about, but all those prices will go up. And a very high percentage of construction labor in the residential market is also migrant labor. And if we have mass deportation of migrant workers, it's going to make labor harder to come by and probably more expensive to hire. So really a difficult scenario in 2025 for flippers between slowly rising home prices, still lack of inventory out there available to purchase, and escalating costs in terms of repair materials and workers.
The other side of the fence that so many investors have had great success with, really post-COVID, is buying rental homes and aggregating them, many of them building out portfolios and building out really the ability to generate income for extended periods of time. When we think about the rental market today, many of those homeowners have done very well with the ability to have increased rents that have helped mitigate some of the increased costs that are so well documented, insurance, taxes, etc. So, as investors think about the opportunities in the rental market, what are some of the yellow flags going up today?
Well, one of the big yellow flags is we've seen a dramatic increase in apartment inventory. And if you're just looking at total share of rental market, there have been about 1 million new apartment units that have come online in the last 12 to 18 months. So that's just competition for rental properties in general. Um, I think there's more of a positive outlook for those rental property investors, though, for a couple of reasons. One is we've had millions of prospective home buyers decide to stay on the sidelines because of affordability challenges. These are people that are now in their late 20s, early 30s, who normally would have moved into a home ownership situation, who have opted to wait for a while. And as they're growing their families, they'd probably be more inclined to rent a house than an apartment because they need more space. Maybe they want a home that's in a good school district, which a lot of apartments may or may not be. So there are some opportunities for rental property investors, particularly in the single family rental category, that are because of today's unusual market dynamics. The challenge, of course, with all the inventory coming to market is it makes it a little bit harder to raise those rents high enough to offset some of the increased costs you were talking about. But the single family rental market has seen higher year over year asking rents than the multifamily market has. And so I think those investors are finding a way to do what they need to do to offset those increased costs.
So you mentioned the multifamily component, and that is a massive number, a million new units in the marketplace for individuals to live in. How does the market absorb something like that? And what are some of the predictions for increased construction even beyond that?
Yeah, a good question. The market is surprisingly absorbing it pretty well. If there is a lingering vacancy, it tends to be at the very high end of the market right now. But everything below that seems to be filling up nicely. Now there are certain regional markets. There are certain places, certain cities where they probably overbuilt a little bit. It'll take a while to fill those up. But if you look at national vacancy rates, right now, they're back to about normal historic levels. You're looking at vacancy rates of somewhere between 4 and 6%, depending on where you are. And those vacancy rates had gotten much lower during the pandemic when nobody was moving and construction had been slowed down. I guess the good news, if you want to look at it from that perspective, Jeff, is that construction starts for multifamily units have cratered over the last year or two. Since this new inventory has come online, the builders have virtually stopped building anything new in the way of multifamily. In fact, my concern is if they don't start building something soon, we're going to find ourselves with a shortage about 2 years out, because the demographics suggest we're going to need more and more housing of both rental units and owner-occupied properties as millennials and the Gen Z cohort come of age.
When investors think about whether it's single family, multifamily, the different opportunities, there was certainly a wide dispersion of folks during COVID. Urban folks going out to the suburbs, even the exurbs. Some of that has changed. When investors think about today where the population movement has either retraced some of those movements post COVID or potentially what's going to happen as the next cohort comes on board to absorb that next big wave of inventory. How do investors think about where the opportunities are going to be, not from a geographic perspective, but urban,
Yeah.
suburban, or even rural?
Yeah, there's a bit of a bifurcation in the market right now, Jeff. We're seeing some of the younger adults migrating back toward inner cities, and they're primarily renting in apartment buildings. And they're doing it for the reason that the previous generations of young adults have done it because it's near the jobs and the shopping and the restaurants and the entertainment and so forth and so on. So we are seeing that. For the kind of investors that we typically deal with and that RCN typically deals with, you're looking at single family properties or maybe a duplex or a triplex. You're looking at a fix and flip opportunity, and it tends to be moving from those central business areas out into the suburbs or even the exurbs. And we're seeing that both from a standpoint of people looking to buy, who are doing what mortgage people used to refer to as driving till you qualify, and driving further and further from that urban center until they find a property they can afford, or looking for more space even in a rental unit. So I do still see if I were an investor looking at ideal scenarios, and if I didn't have to be looking at properties near where I lived, I would probably still be looking at chunks of the Midwest and the Southeast, both because we still have growing populations and growing job markets in those areas, and because property values are still low enough that you can afford to buy something at an affordable price and rent it out and make instant cash flow. But if you're somebody who's in a coastal area on the West Coast or the Northeast, I still think most of these opportunities are going to be moving out into the suburbs, exurbs, or even right up against the border of some of those rural areas.
Thanks for the update, Rick.
Thank you, Jeff.